Hello and welcome to the video on debt financing. In this video, I'm going to talk through the process by which companies raise money in the debt market for long-term financing needs. We will look at the UK gilt market, talk about the types of bonds and the classifications. We're going to look at the relationship between bond yield and credit risk, and finally conclude with the discussion of the duration of the bond. Every country issues the government bond, which is the money raised by the government in exchange for a government bond through investors. Such instruments are generally considered risk-free in nature, risk-free investment in nature, because the probability of a government defaulting on its bond is very, very low. However, there has been cases where developed countries, even US, have defaulted on their risk-free investment options. In the UK, the risk-free investment option is called the gilt market. So the UK government liability, which is issued in pounds or sterlings, it is issued by the DMO, Debt Management Office, and it is done on behalf of the Her Majesty Treasury and listed on the London Stock Exchange. The gilt market as a whole in UK consists of three main instruments: conventional gilt, index-linked gilt, and gilt strips. A conventional gilt occupies 75% of the total gilt portfolio in UK. It pays coupon in form of interest every 6 months. The price of the conventional gilt in the London Stock Exchange is generally quoted with a £100 denomination, nominal value. The other 25% of the gilt portfolio is comprised of index-linked gilt. Generally, these kind of investments are linked to the retail price index for UK. So it adjusts for any inflation loss in the payment to the investors. It was first issued in 1981 and it is continuing since then. Apart from conventional and index-linked gilt, a very small proportion is also in the form of a gilt strip, where stripping of the gilt refers to breaking it down into individual cash flow like a zero coupon gilt, where each investment is considered as a separate investment option. It's a very minor proportion of the total gilt market. Looking at the various types of debt instruments, majority of them are occupied by bonds. Bonds can have various different types. We can have a straight, bullet, plain vanilla bond, which are bonds issued by organizations that pay a fixed coupon at regular interval and pays a par value on maturity plus the principal amount. This is the most common type of bond in the market. Then there are zero coupon bonds, which are bonds that do not pay any coupon. They are generally issued at discount to the face value, and zero coupon bonds are generally issued by governments only. There are some bonds which are variable rate, floating rate bonds, where the coupon paid over time is linked to a market interest rate. As the interest rate increases, the payment of the coupon obligation also increases. These bonds are generally trading at discount. That means their price is always less than the quoted £100 face value. Then there are index-linked bonds, where the payment on those bonds are linked to an underlying base index. Most often than not, this underlying index is a retail price index or an inflation level. So an index-linked bond saves the investor any loss occurring because of rise in the inflation index. Then there are income bonds, where income bonds will only make a coupon payment when the issuing company generates income beyond a certain predefined threshold. When it is not able to make that income, the bond will not issue any coupon in that period, and because of the terms of the income bond, an investor cannot enforce the company to liquidation for non-payment. Then there are irredeemables, perpetuals, or consols, which are bonds that do not have any maturity date. So they keep on paying interest indefinitely in the future. Generally, only governments can issue perpetuals, consols, or irredeemable bonds. Some other variations of the bond could be in the form of a double dated bond, where the bond has a range of possible maturity dates or redemption dates. Generally, these are separated by a definite amount of timeline, like months or years. A callable bond is a bond with a call feature associated with it. Call is a right to buy. So the bond that allows the company to repurchase the bond back from the investor before the maturity date at a specified call price is a callable bond. Generally, the call price is above the par value, so it gives some incentive to the investors to sell it back to the company. There are also bonds with put options enabled. Put is a right to sell. So it gives the investor or the bondholder the option to return the bond back to the issuer before the maturity date and receive the par value. The put option is exercised only after an initial specified time has passed. Finally, a type of bond is a convertible bond where the bond can be converted into shares. So a debt instrument becomes an equity instrument. Generally, the conversion rate is pre-specified. It tells how many new shares the investor will receive if they take a convertible bond in exchange for the bond that they hold in the company. There is always a conversion premium, which is the excess of the conversion value of the bond to its market value that the investor receives as a result of the convertible feature associated to the bond. Apart from the various different forms and features of bond as discussed earlier, bonds can also be classified by the issuing authority. Within this classification, we can classify bonds into three main types. One is the corporate bond, so bond issued by businesses, companies, organizations that could be public or private in nature. Generally, corporate bonds are not perpetuals and not zero coupon. Then there are government bonds, which are bonds issued by the government. The UK government issued bonds are called gilts, and the US government issued bonds are called treasury bills, treasury notes, or treasury bonds. The idea of issuing bond by the government is to fund national debt or to invest in growth and infrastructure. Government bonds can be perpetuals, can be zero coupon in nature. The third type of bond are bonds issued by public or local authorities. They are sometimes also called as municipal bonds. These are bonds issued by the local authority in UK or in US, depending on how long the tenure is of these bonds. They are called differently. So in general, they are about 1 to 5 years in maturity. They pay a coupon, and if they are issued for 1 year in US, they are generally called yearling bonds. Important thing to note is that local authorities, just like Kingston Council, may issue a bond. However, the British government will not serve as a guarantor for such bonds. The income generated by the council would serve as a backup for collateral on these bonds. Looking further at the corporate bonds, there could be three main types of corporate bond issued by private or public companies. This can take the form of debentures, unsecured loan stocks or guaranteed loan stocks. An unsecured loan stock is a bond issued by a company that is not secured against any fixed or floating charge. If the company goes bankrupt, the unsecured loan stock investors have a junior claim over debenture holder claims. That means first the debenture holders will get the money, and then the unsecured loan stock investors will get the balance of their investment. A guaranteed loan stock, on the other hand, are also not secured by company assets or fixed or floating charge, but by a third party. Generally, this is done by the parent company. The parent company serves as a backup or a guarantee for investors who are interested in investing a guaranteed loan stock. The third type of corporate bond is the debentures. Now, debenture as a terminology has different meanings in US and UK. In the UK, a debenture is considered the most secure type of corporate debt, while in US, a debenture could be also a terminology used for unsecured company borrowing. So, staying with the context of UK, debentures could take two forms. One is a fixed charge and one is a floating charge debenture. In a fixed charge debenture, there are certain assets which are assigned as a collateral or a security for the investors in a fixed charge debentures. There are certain requirements that this asset cannot be sold before redemption of the bond, and in case the company defaults on its debenture payment, then this underlying asset could be sold to recoup the money back for fixed charge debenture holders. On the other hand, the floating charge debenture is a claim secured by general charge on all the assets of the company. So unlike a fixed charge debenture, there is no term that sets the company to be unable to sell the assets. The company can still do that. Another way of classifying the bonds is looking at the nationality of the issuer as well as the currency of the issuing organization. Within this context, in UK, there can be three categories. One is a domestic bond issued by a UK company in sterling pounds currency. Then there are foreign bonds or bulldog bonds which are issued by companies which are not incorporated in UK. However, they may issue a bond in pound sterling. The third category are euro bonds. These are bonds issued and traded in the UK in currency other than the pound sterling. The main currencies in the UK market for euro bonds are US dollars and Japanese yens. These kinds of bonds are typically unsecured in nature. They are issued by big companies, multinational in nature, international agencies and governments. The idea is to take advantage of the currency risk or to suppress the currency risk associated with the company's cash flow. And euro bonds are generally issued to the bearer and hold no record, which means that it has increased liquidity and it preserves the anonymity of the issuer. Bonds are sometimes also classified based on the underlying issuer's credit risk. There are three main credit rating companies globally: S&P 500, Moody's, and Fitch. Each of these organizations tend to rate governments as well as listed organizations on the basis of the credit risk. They can give a letter denoted identification, AAA, AA, single A, triple B, double B, single B, and so on and so forth, depending on how risky they consider the firms to be or the governments to be. Bonds that are double B and better are considered investment grade bonds, whereas lower than double B are considered sometimes speculative grade bonds or junk bonds. Government bonds are generally considered default-free, but this is not the case for all governments. For example, US, UK, Germany, Japanese bonds are generally considered investment grade, risk-free in nature because the probability of these governments defaulting is very low. However, some of the countries like Greece and the South American countries have defaulted in the past and hence do not have a very good credit rating associated with it. The price yield of a bond or the cost for raising money for these governments which have low credit rating are higher compared to firms and organizations and governments that are better rated. So the credit rating in a way quantifies the risk inherent in the organization, whether it's a company or a government, and lower credit rating means there is a higher probability of default, and because of the higher probability of default, the cost of raising money for these organizations would be higher. This gives a snapshot of the way the three rating agencies grade organizations and governments globally. Anything over BBB is considered investment grade, and anything below that is considered speculative or junk category. Junk bonds are bonds which have a higher probability of default of the underlying issuer. AAA is the best. It is considered as a prime or high graded investment option, and of course the cost of raising money through bonds for a AAA rated company would be much lower than a triple D rated company. This is a screenshot from Bloomberg for Apple company, and the most recent credit rating has given by Moody's, Standard & Poor's and Egan-Jones rating company. As you would notice, the outlook is considered stable and the long-term credit rating is in the high investment grade category. So the cost of raising money through debt for Apple would be lower because the rating is better. Generally, credit rating companies have a catch-20 situation where they would like the rating to be as stable as possible, so no frequent revision of the ratings. However, at the same time, they want the rating to reflect the current circumstances of the organization. So while rating organizations are very reluctant to change the rating, they are also very skeptical to continue with an existing rating which, if they believe, does not truly reflect the credit risk of the organization. The cost of raising money through a bond or the return by investment in a bond for an investor could be estimated using various different metrics. The two of the most common ones are the current yield and the yield to maturity. The current yield is a very basic estimation where you take the coupon of the bond and divide it with the price at which the bond is trading. That gives a rough estimate of how much return the bond is expected to give, or how much it costs the company to raise money at this moment. However, current yield is not a clean measure of return because it is influenced by various market dynamics and depending on the nature of the coupon payment that is agreed. Yield to maturity, on the other hand, is a better and a more standard measure that is used globally. Yield to maturity is independent of the difference in the coupon rates, difference in the time to maturity for the bonds, and difference in respect to the amount of money that is raised through the bond instrument. The formula for yield to maturity takes into consideration the coupon that is paid and multiplies it with the annuity factor and adds that to the par value discounted at a rate of return The R in this equation is the yield to maturity, whereas P0 is the price of the bond given the coupon, term to maturity, par value, and the yield to maturity information. The last concept here is the duration of the bond. A bond duration comes from the fact that a bond pays coupon as well as a par value at the end of the maturity. Duration is measured in years. Generally, a bond duration is less than the bond maturity. So a 5-year coupon paying bond will have a duration of 4.5 years, which indicate how long it will take on an average for the investor to recoup the money invested in the bond. It's also important to note that there is an inverse relationship between bond price and interest rate in the economy. As the interest rate increases, bond prices fall, and vice versa. Bonds that have a higher duration are more sensitive to changes in the interest rate.